Hi guys, welcome to another video. So in this video we are going to discuss about the investment banking questions. So this is a part 2 of the first video. So if let's discuss about the first questions in this. uh, let's say if the depreciation is a non-cash expense, so why does affects its cash balance? Although depreciation is a non-cash expense, it is a tax deductible, we know that. Since the taxes are the cash expenses, and the depreciation affect cash by reducing the amount of the tax you pay. Let's say first you have the 100 rupees profit and the 10 rupees depreciation. Now your depreciation increased by 10, so it's 20 rupees. So the tax payable amount is now is the 100 minus 20. It's a 80 rupees. On 80 rupees you have to pay the tax. So that's 80 rupees is a basically taxable amount. So first, prior to that, that's a 90 rupees taxable amount, now 80 rupees. So amount your tax amount is basically less, and you have to pay the less tax on the less profit. Where does the depreciation usually show up on the income statement? So basically it could be a separate line item, it could be embedded in the cost of goods sold or the operating expenses. Every company does it differently, but basically it's shown in the P&L debit side. What happens when the accrued compensation goes by the 10? Basically accrued compensation goes by 10. For this question, confirm that the accrued compensation is now being recognized as an expense. Basically, as you suggest, the accrued expenses, like expense we will recognize the expenses when it's generated, not on the cash basis. We will record only on the basis of generation. So assuming that the case is the operating expenses or income statement goes by 10, like your accrued expenses increase by 10, then the operating expenses goes by 10, and the pre-tax income fall by 10, because your profit is prior to that 19. Now operating expenses is goes by 10, then profit is 80, and the net income falls by 6 because you have to pay the tax as well, 40% tax. On the cash flow statement, net income is down by 6 and the accrued compensation will increase the cash flow by 10. Why? Because this is the operating expense and the increase in the operating expenses are there. Then the overall cash flow from the operations by 4, because you have to deduct the tax also. Then the net changes the cash at the bottom by up by the 4. On the balance sheet, cash is up by 4 as a result, so the assets are by 4. So on the liability equity side, accrued compensation liability, so the liabilities are up by 4. Retained earnings are down by 6 due to income, so both sides are balances. What happens when the inventory goes by 10 and assuming you pay for it in the cash? No change in the income statement, no changes in the income statement. On the cash flow statement, inventory is an asset, so they decrease your cash flow from the operations, it goes by 10. No changes to the income statement. On the cash flow statement, the inventory is the asset, so the decrease your cash flow from the operation, so it goes down by 10. So does the net changes in the cash at bottom or on the balance sheet under the asset? The inventory is up by 10 and the cash is down by 10. So the changes cancel out and the assets will equal to the liabilities and the shareholders equity. Why is the income statement not affected by the changes in inventory? No, let's understand the questions. Why is the income statement not affected by the changes in inventory? Like income statement is just like your income statement is showing the profit of 100 rupees and there's a changes in inventory, so how this is not affected? So this is the common entry mistake everyone is doing. So in case of the inventory, expenses is only recorded when the goods associated are sold. Like let's say your inventory is like 10 lakhs. 10 lakhs goods are in your warehouse and there is no sales in that period, in that year, so there is no changes in the inventory. Inventory changes when your goods are sold. Like let's say 10,000 inventory are sold, so 10,000 sales amount, inventory is 90,000. So if just sitting in the warehouse inventories are, so this does not count as a good cost of goods sold operating expense until the company manufactured it into a product and sell it. Next question. Let's say an apple is buying rupees 100 worth of new iPad factories with a debt. Let's say Apple basically Apple is buying rupees 100 worth of the new iPad factories with a debt. Okay, Apple want to buy the new factories with a debt. How all the three statements affected the start of year one before anything else happened? So at the start of the year one, before anything else happened, there would be no changes on the Apple's income statement. There would be no changes in the Apple's income statement. Like, yeah, in the first year there's a no changes because now it's just a starting. Now this is starting of the year. On the cash flow, the additional investment in the factory will show up under the cash flow from the investing as a new reduction in the cash flow. Like on the cash flow statement, the additional investment in the factory, like there's the additional investment like $100 show up under the cash flow from the investing. So cash flow in the investment as a net reduction in the cash flow. So as the additional 100 worth of the debt raised and show up as addition to the cash flow, because we receive the cash now, we will receive the cash when the debt uh, when the debt is raised, and cancelling out the investment activity, the cash number stays on the same. On the balance sheet there is now an additional 100 worth of the factories in the plant and equipment, because it goes up by the 100 rupees. So PP is up by the 100 rupees and the asset is therefore up by the 100 rupees. So PP is worth by the 100 and the asset is also by the 100. On the other side, debt is up by the 100 as well as the both side balances. Debt is goes by the 100, so there's basically assets and PP are balance and debt is also balanced. So both sides are equal. Now let's go out the first year to the start of second year, like it's a completely whole year. Assume the debt is high yield, basically debt is high yield expenses, so no principal is paid paid off. So there is a no principal payment in debt period, and assume an interest rate of the 10%. So there is an interest rate of the 10%. Assume the factories depreciate at the year at the rate of 10% per year. What happens? So after a year has passed, Apple must pay the interest expense and must record the depreciation. After a year has passed, Apple must pay the interest expenses and must record the depreciation expenses also. Operating income would decrease by 10%, sorry, by 10 due to a 10% depreciation charges each year. And the $10 additional interest expenses would decrease the pre-tax income by 20 altogether. Assuming a tax rate of the 40%, net income would fall by the 12%. On the cash flow statement, the net income at the top is down by 12%, sorry, $12, and the depreciation is a non-cash expenses. So you add it back, and at the end result is the cash flow from the operation is down by the 2. That's only change on the cash flow statement. So the overall cash is down by 2. On the balance sheet under the asset, cash is down by $2 and the PP is down by $10 due to depreciation. Overall assets are down by the 12. On the other side, in net income was down by 12 and the shareholder equity is down by the 12. So both side balances. So this is a basically video. So in this video we are going we will basically discuss here up to here. I will continue from the next video. Stay tuned, subscribe to the channel.